In February of this year, a small bank most Americans had never heard of failed. Metropolitan Capital Bank was not large, it was not systemically important on its own, and the FDIC handled the resolution about as cleanly as these things go. Deposits transferred, insured money protected. The whole event wrapped up with almost no drama. But it happened during the same stretch that gold, silver, and Bitcoin all sold off sharply together, and that combination is what actually made traders sit up. A quiet bank failure landing in the middle of a violent sell-off across every asset people usually run to for safety is not a normal pairing. It raises an obvious question. Is this an isolated event or an early tremor from something bigger that hasn't finished playing out? That question matters because most people think the banking crisis already happened back in March of 2023, when Silicon Valley Bank collapsed almost overnight, taking Signature Bank and eventually First Republic down with it. That version of the story has an ending. Rates spiked. A handful of poorly hedged banks got caught holding long-duration bonds funded by short-term deposits. Depositors panicked, and the Fed stepped in with emergency lending facilities to stop the bleeding. Clean narrative, clear resolution, case closed. Except that's not actually what the data shows. What happened in 2023 was the fast version of a problem, the version that moves in days. There's a slower version of the same underlying issue that has been unfolding for 3 years now, and it hasn't resolved. It's just been moving at a pace too slow to make headlines, which is exactly the kind of risk that tends to get underpriced by markets. Start with the mechanism that actually broke Silicon Valley Bank, because it explains everything that follows. Banks hold large portfolios of securities, mostly treasuries and mortgage-backed bonds. Some are classified as available for sale, meaning their value gets marked to market every quarter and any loss shows up on the bank's books immediately. Others are classified as held to maturity, meaning the bank doesn't have to recognize the loss on paper as long as it holds the bond until maturity and gets its principal back. When interest rates rose sharply starting in 2022, the market value of both categories of bonds fell hard since bond prices move inversely to rates. For most banks, this was a paper loss they could simply wait out. For Silicon Valley Bank, a wave of deposit withdrawals forced them to actually sell some of those underwater bonds to raise cash, which converted a paper loss into a real one, which spooked depositors further, which forced more selling. That's the death spiral in a sentence. Unrealized losses only become dangerous when you're forced to realize them. Here's the part that rarely gets mentioned when people talk about that crisis being over. Those unrealized losses across the American banking system never actually went away. At their peak across 2022 and 23, they exceeded $600 billion, according to FDIC data. By the fourth quarter of last year, that figure had fallen to just over $306 billion, the lowest level in years, as some of those securities matured and rolled off at par. That was real progress. Then the first quarter of this year reversed it. Unrealized losses on securities climbed back to roughly $325 billion, a jump of $19 billion in a single quarter, splitting out to about $214 billion sitting in held-to-maturity portfolios and around $110 billion in available-for-sale securities, based on the FDIC's own quarterly banking profile. None of that means another Silicon Valley Bank is imminent. The industry as a whole earned over $80 billion in net income that same quarter, and the FDIC's own problem bank list, meaning institutions with the weakest supervisory ratings, sat at 54 banks in the first quarter, about 1.3% of all banks nationwide. That's within the normal historical range for a non-crisis period, typically 1 to 2%. Looking only at the headline numbers regulators publish, the system reads as stable, not fragile. But headline stability at the system level can coexist with real concentrated stress underneath it, and that's precisely what the commercial real estate numbers are showing. This is where the slow version of the crisis actually lives. Roughly $936 billion in commercial real estate debt is scheduled to mature in 2026 alone, an increase of close to 19% from the prior year, according to recent market data trackers following FDIC disclosures. Office delinquencies sit around 6.8%, multifamily close behind at 6.6%. Those aren't abstract numbers. They represent loans made years ago at much lower interest rates on properties whose valuations were built around pre-pandemic assumptions about office occupancy and rent growth. When those loans come due now, refinancing means borrowing at rates roughly 1.5 to 2 points higher than the original loan on a property that in many cases is worth less than when the loan was written. That math doesn't always work. And when it doesn't, banks and borrowers have mostly chosen a third option: extend the loan, modify the terms, push the reckoning further down the road, and hope conditions improve before the next maturity date arrives. That's not a conspiracy or a cover-up. Extend and pretend, the term the industry itself uses for this, is a rational response by both lenders and borrowers when neither side wants to force a sale into a weak market. But it means the losses don't disappear. They get distributed across a longer timeline instead of hitting all at once, which is why this version of the banking story doesn't generate a single dramatic headline the way Silicon Valley Bank did. It generates a slow accumulation of stress that shows up gradually in specific institutions rather than the system as a whole. Regional banks carry this risk disproportionately because they hold a much larger share of commercial real estate loans relative to their total balance sheet than the large national banks do. Zions Bancorp reported losses tied to commercial and industrial loans that reignited concerns among analysts who track regional bank exposure closely. Academic researchers studying bank balance sheets have identified specific institutions, Flagstar among them, where concentrated exposure to underperforming New York City commercial properties leaves the bank undercapitalized under realistic stress scenarios, even though it remains fully functional today. That's the pattern worth watching, not a system-wide collapse, but a rolling series of localized pressure points, each one individually containable, each one a reminder that the underlying vulnerability hasn't actually been resolved. Some regional banks are now cautiously re-entering commercial real estate lending after years of pulling back, citing lower interest rates and what they describe as stabilizing credit quality. PNC's chief financial officer told investors the bank expects moderate growth in its commercial real estate book this year. That's either a sign the worst is behind the sector, or it's the same instinct that shows up at the end of every credit cycle, where lenders start extending fresh credit into a market just as the deferred losses from the last cycle are still working their way through the system. Both interpretations are defensible. Neither can be proven yet. So where does gold fit into all of this? Gold's relationship with banking stress isn't as simple as crisis happens. Gold goes up. History shows a more complicated pattern, and it's worth walking through because it directly informs how to think about today. During the acute phase of the 2008 financial crisis, gold initially fell alongside almost every other asset because when a genuine liquidity crunch hits, institutions sell whatever they can to raise cash, including gold. Only in the aftermath, once central banks responded with massive rate cuts and quantitative easing, did gold enter its multi-year rally as investors repositioned around currency debasement and near-zero interest rates. Compare that to March 2023, when Silicon Valley Bank failed. Gold moved up almost immediately because that event was narrower and faster, and investors treated it as a direct signal about financial system fragility rather than a broad liquidity event forcing indiscriminate selling. The banking stress unfolding now looks like neither of those templates exactly. It's slow, not sudden. It's concentrated in specific institutions and specific loan categories rather than threatening the system broadly, which means gold's relationship to it isn't being driven primarily by acute banking fear the way it was in 2023. It's being driven by something else, something structural, and that's the more important story for anyone holding gold or considering it. Central banks have been accumulating gold at a pace with no real precedent outside of wartime reserve building. In the first quarter of this year alone, central banks purchased a net 244 tons, according to the World Gold Council, exceeding both the previous quarter and the 5-year average. Poland has led the buying, adding 31 tons in that quarter as part of a stated multi-year plan to build reserves towards 700 tons total, driven explicitly by security concerns along NATO's eastern flank. Uzbekistan, Kazakhstan, and China have all been steady buyers too. The full-year forecast for 2026 sits around 850 tons, which would be the second consecutive year above 800 tons and more than double the 400 to 500 ton annual average that was normal before 2022. That year, 2022, is the hinge point, when roughly $300 billion in Russian central bank reserves were frozen following the invasion of Ukraine. It demonstrated something every finance minister and central bank governor in the world had to take seriously. Foreign currency reserves held inside another country's financial system can simply be seized by political decision with no court process a sovereign nation can appeal to. Gold held domestically cannot be frozen or sanctioned the same way. For smaller economies especially, buying gold stopped being a speculative macro trade and became something closer to an insurance policy against a geopolitical risk that had just been proven real. In the World Gold Council's most recent central bank survey, 89% of reserve managers said they expect global central bank gold holdings to keep rising over the next year, the highest reading in the survey's history. That's the deeper reason gold has repriced toward roughly $5,300 an ounce this year. It's not primarily retail investors chasing a trend, though retail and ETF demand matter too. It's price-insensitive sovereign buyers who aren't trading momentum. They're rebuilding a strategic reserve position over a multi-decade horizon, largely independent of what's happening with any individual bank's balance sheet in any given quarter. So you have two separate stories running in parallel. One is the slow motion credit stress building in regional banks through commercial real estate, real documented and unresolved, but contained enough that it hasn't produced a systemic event since 2023. The other is a structural, multi-year shift in how central banks think about reserve composition driven by geopolitical risk rather than banking sector health specifically. The banking stress and the gold buying are both happening, but they're not the same story with a simple causal arrow between them. Untangling that is the key to thinking clearly about what comes next. Consider the honest range of outcomes here, because pretending there's one obvious answer wouldn't be fair to the evidence. The bullish case for gold rests on both threads reinforcing each other over time. If commercial real estate losses keep accumulating gradually and eventually force a more visible resolution at one or more mid-sized regional banks, that would plausibly trigger the kind of acute safe haven bid gold saw in March 2023, layered on top of already elevated central bank buying that shows no sign of slowing. Goldman Sachs, in a note published earlier this year, raised its December 2026 gold price target of $5,400, arguing that private investors who bought gold as a hedge against fiscal sustainability risk rather than against a single specific event are likely to hold those positions for longer, since that underlying risk isn't resolving anytime soon. The bearish case deserves equal weight. The FDIC's own data shows the banking system generating strong net income, a problem bank count within normal historical ranges, and a deposit insurance fund that grew to $157 billion in the first quarter, comfortably funded. If commercial real estate losses keep getting absorbed gradually through extensions and modifications rather than forced sales, the entire crisis isn't over. Framing could simply fade as a non-event, the way many predicted credit disasters have faded before without a dramatic resolution. On the monetary side, if the Federal Reserve holds interest rates higher for longer, which it has done in recent policy meetings while evaluating incoming leadership, that raises the opportunity cost of holding a non-yielding asset like gold, a headwind fully independent of anything happening in the banking sector. The neutral case is probably the most defensible read available right now. Two separate forces, slow building regional bank credit stress and structural central bank gold accumulation, are both in motion, verified by public data. Whether they intersect in a way that produces a sharp move in gold, or whether they simply continue running in parallel without ever colliding into a single dramatic event, isn't something the current data can answer with confidence. History offers examples of both outcomes. Sometimes slow building credit stress does eventually force a disorderly resolution. Sometimes it gets absorbed gradually enough that in hindsight, nobody remembers it as a crisis at all. Who benefits and who's exposed in this environment? Central banks accumulating gold are by design insulated from short-term price swings since they're not trading around a target, they're building a decades-long position. Long-term individual holders of physical gold are in a similar position, exposed mainly to opportunity cost if prices stay flat for a while, not to a structural risk. Regional banks with concentrated commercial real estate exposure are the clearest point of vulnerability, particularly those with large office or multifamily books in markets where valuations haven't fully adjusted. Uninsured depositors at smaller institutions carry real, if statistically small, tail risk, which is precisely why watching the FDIC's quarterly problem bank list matters more than watching any single bank stock price. Private credit funds have been stepping in to fill financing gaps as traditional banks pull back from riskier commercial real estate lending, which shifts some of this risk outside the traditional banking system entirely into a less transparent corner of the market that doesn't show up in FDIC data at all. What are professionals actually tracking beyond the spot price of gold? The FDIC's quarterly banking profile, which reports unrealized securities losses and the problem bank list every quarter without much media attention. The Federal Reserve's weekly H.8 release, which tracks aggregate bank credit by category, including the multi-trillion-dollar commercial real estate line. The World Gold Council's quarterly gold demand trends report, which breaks out central bank purchases by country in granular detail. Real yields on Treasury inflation-protected securities, since gold competes directly with real yields as a store of value, and rising real rates have historically been one of the few forces strong enough to slow central bank and investor gold demand simultaneously. And commercial real estate maturity schedules published by the Mortgage Bankers Association since the timing of the next wave of loan maturities tells you roughly when the next test of extend and pretend arrives. What assumptions here might be wrong? The bullish framing assumes commercial real estate losses keep accumulating without ever forcing a disorderly resolution, but extend and pretend has limits. Loans can only be extended so many times before a lender has to recognize reality, particularly if short-term rates don't fall enough to make refinancing viable. The bearish framing assumes the system-wide FDIC numbers, which look healthy, fully capture the risk, when the entire point of the regional bank concentration argument is that averages can hide the institutions where the real exposure sits. And the central bank buying thesis assumes that pace continues uninterrupted, but Russia and Turkey have both been net sellers of gold this year, Russia under fiscal pressure tied to war spending, Turkey managing domestic currency stability, a reminder that even structural buyers can become sellers when their own domestic conditions demand it. So where does that leave someone trying to think clearly about all of this? The banking system, viewed through its own regulatory data, looks stable in aggregate. The commercial real estate stress underneath that aggregate picture is real, documented, and hasn't resolved. It has simply been extended across a longer timeline than a single dramatic headline could capture. Gold's current strength is being driven mostly by a separate, structural story about central banks rebuilding reserves in a more fragmented geopolitical world, a trend that's been building since well before this year's banking headlines and doesn't depend on any single bank's balance sheet. The two stories can reinforce each other. If regional bank stress eventually produces a sharper event, they can also simply continue running side by side indefinitely, never quite colliding into the single crisis moment that would make for a clean headline. What's worth carrying away from this video isn't a forecast for where gold goes next. It's a different way of reading financial news. The events that make headlines, a bank failure, a Fed decision, a single day's price move, are usually the visible tip of processes that have been building quietly for months or years, and the data regulators publish every quarter without much attention. The FDIC report that showed unrealized losses ticking back up barely made the news. The commercial real estate maturity data barely makes the news. But that's where the actual story of whether this is contained or still unfolding is being written, well before any single event forces it into a headline. So here's a question to carry forward. If the most important signals in a slow, moving credit story show up in quarterly regulatory filings that almost nobody reads, and the most important signals in gold structural repricing show up in central bank purchase data that most retail investors never check, how much of what actually moves these markets over the next few years is going to be visible to you in real time, and how much of it is only going to make sense in hindsight the way the 2023 banking crisis does now? If breaking down these signals is useful to you, liking this video and subscribing helps more people find grounded, data-driven analysis instead of the noise that usually surrounds both banking headlines and gold price predictions. And if you want to understand how this same commercial real estate maturity wall could ripple into the broader credit markets over the next 2 years, there's another video that walks through exactly that, and it's a natural next step from everything covered here.